Revenue looks good. Profits look great. But beneath the surface lies the balance sheet. Smart investors, they dig deep into it. Because a strong balance sheet isn't just important. It's what keeps a business alive when things go wrong. It's the foundation of any great company. In this video, I'll show you how to identify a strong balance sheet, avoid risky companies, and invest with confidence. Let's start with the basics. What is a balance sheet? A company's balance sheet shows three things. Assets like cash, inventory, property. Liabilities like loans, accounts payable. Equity, what's left for shareholders. The formula is simple. Assets equals liabilities plus equity. And the concept, just as clear. A strong balance sheet means the company can easily pay off its debt. Or even better, it has no debt at all. But what truly matters is knowing how to use them to find the companies built to last. There are many kinds of metrics to evaluate a healthy balance sheet, like positive net asset position, low debt-to-equity ratio, or high current ratio. But I'm going to show you the CY way, a practical method that works. First, we need to adjust the value of the assets to reflect their real worth. Because when things turn ugly, everything gets dumped at fire sale prices. What you see on the balance sheet isn't what you actually get. Cash and cash equivalents and short-term investments, leave it as it is. It's already liquid. Receivables, discount them by 30% because some customers may never pay. Inventory, cut it even more. In a fire sale, it could lose 30 to 80% of its value. Property or equipment, it depends on how specialized it is. Generic assets might retain value, but niche equipment could be almost worthless, reduced by 30 to 80%. Goodwill and intangibles refer to things like patents, brand value, and other non-physical assets. How much of that can you actually sell to pay off debt? Some I cut in half. Others, I write off completely. How you adjust each asset depends on how well you understand a company. But if you're unsure, play it safe, give a bigger discount. If, even after adjusting the assets, the company can still easily pay off its debt, that's a clear sign of a strong balance sheet. These are the three metrics I use to define a strong balance sheet. Number 1, cash, cash equivalents, and short-term investments should be greater than total current liabilities. That means the company can cover all its short-term obligations without relying on any other assets. Number 2, total liabilities should be less than 40% of the adjusted assets. When liabilities are low, the company can survive tough times and even take advantage of opportunities in a harsh economy. Number 3, the total liabilities to total assets ratio should be decreasing year by year. We want to see companies consistently growing their assets or paying down their debt over time. When a company has no more debt to pay and it's generating more cash than it needs for growth, all that extra cash comes to you, the investor. These metrics might not apply to every industry. For example, banks naturally have higher liability-to-asset ratios. But the core idea remains the same. We want companies that can seize opportunities, even in tough environments. Most investors look at revenue and profits. But smart investors, they look deeper at the balance sheet. One video, one good idea, it can change the way you invest forever. If you found this useful, give it a thumbs up, drop a comment, and hit subscribe so you don't miss the next smart investing idea.